listen to a wonderful panelists here who have lots of experience in that, from the banking side, from the legal side, and also from the SPAC side. So I think it'll be a great session today evening. The way that we are going to do this is that as you are listening to that, and if you have questions, please put in your questions on the chat box. And then once the panelists, we can either interrupt and ask them, or when the Q&A time comes, we'll look at all the questions and try to answer as much as we can. A couple of commercial for TiE. TiE Silicon Valley, as you know, is an organization set up by the entrepreneurs for the entrepreneurs. We have multiple ways to support the entrepreneurial ecosystem. We provide educational sessions like this. We provide networking opportunities. Unfortunately, with the COVID, we're not doing that much in-person events, but feel free to use the chat and get to know each other if you find known people there. We also have opportunities to incubate, invest, and mentor. So all of that we do at TiE. These are the 5 pillars of TiE. And with that said, we have in the first week of March, May, we have our marquee event. The TiECon is coming up, and preparation is underway. So if you do want to learn about it, please watch the TiE messaging that comes across in various social media channels. And then don't forget to register for TiECon. With that said, let me introduce Mariam, who's going to be moderating the panel. Mariam, please take it away. Thank you.
Sure. Hello, everyone. It's a pleasure to be here, and thanks, AGK, for the opportunity to participate in this panel. My name is Mariam. I'm a director at Citibank's financial sponsors team. I've been with Citi for past 7 years, covering private equities, SPAC franchises, and sovereign wealth funds. I've been working with Isabel and Kirtiga for past almost more than a year, and I'm very excited to introduce you to them and to kick off the panel. Isabel, Kirtiga, do you want to introduce yourselves?
Hi, so I'm Isabel Friedheim. I am the chairman and CEO of Athena Technology Acquisition Corp. 2 and chairman of Athena Technology Acquisition 1 and Athena Consumer Family, Athena family of SPACs. I have a background in investment banking and private equity, but have been both an entrepreneur and an investor. I co-founded a couple of fintech companies. My last fintech company was acquired a year ago, and I have a number of investments in my venture portfolio, and now have been full-time focused on the SPACs.
I'm Kirtika Reddy. I wear the proud hat of being a TiE Silicon Valley board member, and I'm thrilled about TiE Silicon Valley's efforts to be at the forefront of next-gen technologies and their focus on youth and diversity. I'm here in this panel wearing my other hat as president and director of Athena Technology 2, the third in a series of all-female-led SPACs, as Isabel mentioned. And the SPAC platform uniquely blends my background from having been an investor, most recently with the SoftBank Vision Fund, where my focus has been deep tech, enterprise, fintech, health tech, crypto, gaming, and also my operating executive background, where I've held operating executive roles like leading Facebook in India, starting as employee number 1. Very excited to be here. And with that, we'll have Joel introduce himself.
Thanks. I'm Joel Rubenstein. I'm a partner with White & Case, a law firm in New York, based in New York. And I've been working with SPACs for close to 20 years at this point. I think many of you probably are thinking there were SPACs 20 years ago. And the answer is there were, but it's clearly been quite a journey and really became a much more mainstream product in the past year, and excited to be here to talk more about it tonight.
Thank you, everyone. And on that note, the SPACs becoming a mainstream product past year, I will start with the first question. I would let Isabel start with that. But Isabel, there has been a huge SPAC boom in past couple of years, especially like past 2 years. Right now, there are around 600 SPACs with more than 150 billion capital outstanding, looking for targets. To start our discussion and give the quick background, what were the drivers of this SPAC boom?
So yes, what drove the boom in SPACs? So each one of the constituents that is participating saw a great advantage. So let me go through each of the constituents. So on the sponsor side, the economics for a successful completed deal are attractive. So sponsors get 20 to 25% of the pro forma IPO amount. And there was certainly a big incentive for sponsors to raise SPACs. On the investor side, many SPACs are funded by a yield play on behalf of hedge funds. So hedge funds can borrow the lion's share of the amounts that they invest in the IPO and get warrants for free. Therefore, there was a yield play that made it so that it was an incredibly attractive risk-adjusted return for hedge funds, particularly in a low interest rate environment. For companies that would combine with SPACs, with the onset of COVID, you will remember that the markets were wish-washing multiple percentage points every day. And SPACs offered a number of benefits relative to a traditional way IPO. In a SPAC, the work is all done versus a year of management distraction working on the S1, on the roadshow, on pricing an IPO, and this is all very painful. There was near-term valuation visibility, unlike in a traditional IPO where your valuation is established in a year from now based on where the comps are on the given week following your roadshow. So the volatility in the markets made a traditional way IPO virtually unviable. And the SPAC also offers speeds to markets. So I think most entrepreneurs are aware of the fact that we are in a moment in time when the market is at an all-time high and want to take advantage of that. And those are the benefits to a company, and SPACs were a better way to access the public equity markets. Then the sheer volume of companies that were bottled up in the private markets created an opportunity in and by itself. So the average lifespan of a company in the S&P 500 was 60 years in the 1950s, and that number has gradually gone down to 12 years, and it keeps accelerating. And what that means is companies that were large S&P 500 companies for much longer than there are now, and that velocity of companies that come in and out is a testament to the technology innovation that creates disruptors, and many of them who are private companies going public. So in the last 10 years, Yahoo, for example, came out of the S&P 500, as did Xerox and the New York Times, Monster Job Search, and TripAdvisor, for example. There have been over 200 total exits of companies that we all know well, that we've grown up with. And of course, in many cases, they've been replaced by technology companies that were once private. And so the last constituent is the PIPE investor. And the vast majority of SPACs, the transaction is executed concurrently with a PIPE, a private placement in public equity. And that serves as third-party validation on the valuation that was established between the company and the sponsor that are combining. Most long-only equity investors were not able to participate in the outsized returns achieved by the venture capital firms who have invested over the years in the tech giants of today. And SPACs offered those investors an opportunity to create a portion of their portfolio attributable to new age economy companies. So those are the drivers of the SPAC boom.
Thank you, Isabel. And quick follow-up question: where do you see the SPAC market right now? Like, has anything changed? What is the current state, and where we stand right now as compared to last year, for example?
Well, so tell me where you sit, and I'll tell you where you stand. Let's go through each one of these constituents that I mentioned earlier and see how that has changed. So for sponsors, there is still an opportunity to IPO SPACs, but it's not as strong. Why? Because investors are now demanding higher yields. Therefore, sponsors have to overfund the trust. They have a shorter amount of time to get deals done. That being said, it's still an attractive opportunity. So the economics have softened and investors are largely favoring serial SPACers who have the credibility of having gotten a deal done. Look at another constituent that we just discussed, investors in the IPO. Many have the allocation into SPACs already, as there are currently 600 SPACs, as you mentioned, Miriam, looking for a combination. So most of those IPO investors have their allocations, and as they're looking at a rising interest rate environment, the economics need to improve for them, which is at the detriment of the sponsor. For companies, it's still an attractive proposition for the reasons that existed before, but particularly with the equity markets near all-time highs, that's when you want to access the capital markets. But since the PIPE market has moved so significantly, companies have become more reticent because they want assurances on minimum cash and on commitments. So let me explain. The last constituent that we discussed, the PIPE investor, many have largely filled the allocations in their portfolios on the PIPE front as well, and what they had originally set out to achieve. So for those investors, they would need to recycle that money by exiting other investments, or they would need to be further penetration in new pools of capital to maintain the ease that existed in accessing PIPEs a year ago. Instead, what has happened is the required return for those investors has increased significantly. Therefore, PIPE investors are typically demanding a 30 to 40% discount to where they expect the stock to trade on a fully distributed basis. So in light of that, what have we done and what are we doing? So I launched the first all-women SPAC, all managers, board members, investors, and I made sure that the talents that we had in our team was the best in the industry. As a result, all our IPOs were oversubscribed. We found a combination partner within 4 months, and we secured long-term investors in our pipes, JP Morgan, Morgan Stanley, Capital Group, ArcelorMittal, and within barely more than 3 months, we combined with Heliogen, which is an ESG company backed by Bill Gates. And we were able to launch more SPACs that were multiple times oversubscribed in their IPOs. So the last one in October, for example, was 5 times oversubscribed in a challenging market for SPAC IPOs back in the fall. But investors saw tremendous value in our talent and our execution capabilities. As management board advisors, we have people who have been on large corporate boards of Comcast, EDA, Aetna, Oracle, and many others. We have founders, we have a dozen former CEOs and current CEOs, we have regulators on the board. We had a former SEC commissioner on our board, for example. We have been collaborating with the SEC and presenting to their advisory committee. We have people like Karthika, who was at SoftBank and who ran Facebook in India. We have just many executives who are America's top executives and board members. So today, the companies that are approaching us know that they will be the beneficiary of all the capabilities of the Athena companies. And that has afforded us the ability to be selective about the companies that we partner with. And since we created a platform, we have always been oversubscribed. We've been able to curate our investors to ensure that they're not just yield play IPO investors, rather they are PIPE investors who want to further support the companies that we partner with.
Thank you, Isabel. And to take a step back, as Isabel said, where we see current SPAC market right now is that if companies who are looking to de-SPAC and merge with SPACs, they're looking for high quality sponsors such as Athena, for example. But to take a little step back, and Joel, you've been advising the SPACs for the past 20 years, as you said. How have you seen the space being evolving, and specifically from your perspective, how the regulatory environment has changed and where it stands right now compared to, let's say, 2 years ago?
Sure. So it's changed tremendously. When I started doing SPACs, they were much smaller vehicles, $50 million, really for real micro-cap companies. The warrants that you see in the IPO, so just for everyone's benefit, right? When the SPACs do their IPOs, they offer units consisting of a share and a warrant. The warrants were originally structured just to allow the company to actually raise additional capital. That was the whole point of it. And so the market evolved over time. I think 2007 was really one high point right before the financial crisis, where I think it was a third of the IPO market was SPACs. Then we had the financial crisis 2008, SPACs and pretty much all capital markets deals disappeared in 2009. And then 2010, things started to come back. There were some structural changes made with a steady growth until I would say pretty much the end of 2019, early 2020. And then there were a few deals that really were a catalyst, I think, for the market to grow as it did. One of them in particular was DraftKings, because that was a company that people actually heard of. You know, Conan O'Brien recently tweeted, "I haven't seen an ad for online betting in 7 minutes. Am I dead?"
Yeah, I remember that.
And so, you know, that was something people had heard of, and it really, and retail really got very into it because of that. And so that was a very successful deal. And people really took notice of it from all directions: sponsors, target company, you know, companies that want to go public through a SPAC, et cetera. So that's pretty much, you know, and then it just became explosive. As I said, back half of 2020 was, you know, an incredible number. And then really hitting its height in January of 2021 in terms of the IPOs. And then I would say a couple of things started to happen when you say like regulatory wise. So we had, first of all, the SEC started to take a lot more notice of this. The SEC always had been regulating. I actually went down to the SEC in 2010 to meet with a whole bunch of people when you actually met with people in person, to get some changes through. And so they've always been looking at it and regulating it, but everything seemed to be, you know, in a good place. But then with the explosion, it definitely caused them to be much more carefully looking at things. And not only that, the larger companies that started to get involved, you had other people looking at it. So for example, a lot of times these smaller companies before, they didn't always have big four auditors, things like that. So you had a lot more attention from the auditors, et cetera. So a couple of things happened in 2021 relating to accounting issues, et cetera. We had a changeover in the SEC where we have a different chairman now who's much more focused on regulation and investor protection. And so you're starting to see a lot more coming out from them. At the same time, unfortunately, there were a few deals where, for example, projections were given and maybe the underpinning of those projections was not great. And their stock plummeted because they didn't do what they said they were going to do. And then you had lawsuits. So, you know, you had a little bit of choppiness in the market from a regulatory and a legal perspective. Having said that, so kind of brings you to where you are, as we heard from Isabel before. You know, the market today is a lot more challenging, but it's a lot more challenging for regular way IPOs too, in the earlier stage companies, which are really driving a lot of this market. And so I think that's pretty much where we are.
Thank you. And quickly to follow up on that, where do you see that going forward? Where the, like, from the regulatory perspective?
So the best that we could tell, the SEC is very focused on disclosure. So what they want it to be really clear to investors where the incentives lie. What incentivizes the sponsors, what incentivizes the bankers, and they want it to be clear under different scenarios how everyone will make out. So if the stock trades to $15, how is everyone going to make out? If the stock trades, unfortunately, down to $7 or $5, how is everyone going to make out? And so they want people to be able to see that, because there can be situations where, for example, if the stock trades down, sponsors may still make a profit, whereas the public investors will not. And that's been a source of focus. I mean, it's always, having written the disclosure for years, it's always been disclosed, but I think there's a focus on that. So I think what we expect to see in the spring, some rulemaking, et cetera, coming out from the SEC, which will formalize a lot of that. Chairman of the SEC, Gensler, has also put out there that there may be some other changes they are considering, which could be more along the lines of some of the things that SPACs have advantages over IPOs are. For example, I mentioned projections. In a normal IPO, you cannot directly provide projections because the underwriters have liability and they won't allow you to do that. You don't have direct underwriter liability in a SPAC deal, so there's projections put out. So that's one area that they've been looking at, thinking about whether that's appropriate or not. And there's some other areas too. So it remains to be seen where it goes. Personally, I think the market is self-correcting right now. And so in the end of the day, I think that we will see things really, come to a head. And then hopefully once we see that specter of SEC regulation leave, I think things will normalize.
Thank you so much. We appreciate your perspective. And now speaking a little bit from the entrepreneur's perspective, right? And entrepreneurs and company founders, like many of those in our audience today, when they think about how they grow their business and get the capital they need to get them where they want to go, there is a lot of things for them to consider, right? And this is the question that I would encourage all the panelists to chime in, but I would like to start with Kirtiga. Kirtiga, can you please talk a little bit about the considerations of staying public, of staying private versus going public?
Certainly, Mariam. And to your first question about how the SPAC market has changed, I will add that about this time last year, when I was with SoftBank Vision Fund, there was, I'd say, almost an unhealthy boom of the number of SPACs in the market where, I think all of the portfolio companies in SoftBank Vision Fund were being approached by multiple SPACs. Many SPACs were first-time SPAC sponsors and might not even have had the right expertise. So we certainly saw that. And over the course of the year, I have seen that has tapered to a more healthy place where we have seen a lot of quality SPAC sponsors come into the market. I have had the privilege of working with several such SPACs, whether it's Nicolo from DMYI for IonQ or Vivek Ranadive from Bowix for WeWork. So three of my companies at SoftBank Vision Fund went public, all three via SPAC. So have seen that shift from that side of the table. To your question then about how should companies think about staying private, going public, the bottom line there is what is the path that helps maximizes long-term value. Okay. Certainly, as companies think about making the choices, there are some prerequisites that you need to have before you start thinking about going public. Do you have predictability in revenue? Do you have the right financial processes to support the public company standards? Do you have the right team to operate as a public company? Assuming that you have all of that in place, you still have the choice of staying private or going public. And a lot of times that choice does come down to the founder vision and the point of where is it that they can maximize long-term value. It could be that the company is at a space where they feel confident that they can continue to raise capital in the private market and continue to grow at the optimal pace without incurring the overhead of being a public company. But then we've also seen companies that say they're ready with all of the processes, the team, the ability to predict revenue, and they see a possibility to accelerate their pace, whether it is with access to public equity capital markets, whether it is a lot of the companies that we are talking to, Mariam, for Athena Technology too, they see that opportunity to accelerate their go-to-market strategy, build out their brand with key stakeholders, accelerate their M&A plans. So these are some of the reasons why they then gravitate to going public, because it feels like they can accelerate long-term value creation. I had one of the CEOs of a very high growth private company, one of their top 3 reasons for wanting to go private, wanting to go public, even while they had a very robust secondary offering system, was for the ability to attract engineers to a late stage company, right? So ultimately, again, it comes down to where is it that they can drive long-term value. And the rule of thumb that I often advise entrepreneurs is think about this in the 2 to 3+ year time frame. Which path now can get you further ahead? And that will often drive the decision.
Thank you. I appreciate it. We'll go back to your first point of there being a lot of SPACs out there. But before I do so, I would like to hear from Isabel. What about going public via SPAC versus an IPO? And from Joel, having represented companies in both transactions, what are some pros and cons of two ways you can go public, IPO versus SPAC?
There are lots of reasons why SPACs are attractive to companies, and those reasons haven't changed. They are the same now as they were 18 months ago, as they were a few years ago, frankly. So the number one reason, and actually I can't rank them, but they're all attractive, but there's the certainty of valuation. I mean, with a SPAC, you know what your valuation is because you've negotiated it privately with the sponsor, whereas with an IPO, you are subject to whatever the market is at and the comps are at in a year from now, or whenever you file, you start the process of looking into the IPO. And if you don't pull it off, it's really hard to recover from that. If you don't like the valuation, you just either you take it or you pull out. And if you can't get the IPO done, then it's again really hard to come back from that and go public. And then there's the length of time that it takes to go public through an IPO versus a SPAC. I mean, it's a distraction for the management team. And so the SPAC is able to minimize that distraction. There's the ability to present projections, but more importantly, there's the ability to tell the story along with the SPAC sponsor and to engage with investors in a very different way. So those are real reasons why SPACs are attractive.
Yeah, and Mariam, if I were to just add to what Isabel mentioned, like we have had companies where their founders have told us they were public officers before, have been through the S1 process that the IPO listing process entails, and they'd much rather prefer the S4 process that a SPAC involves compared to the S1. To the point of being able to tell the story, again, really important. Companies that are, say, in the 100+ million revenue range that might need to wait a few years to access the IPO market now see that ability to go a little faster with that focus on long-term value creation. And I think they've heard many, many stories of how into the other part that Isabel described, where there's market volatility, you go through an IPO process, you have to make the pricing decision. And there are companies that might not like the pricing, but they're just so exhausted with the process that they still go through with that process, right? So all of those are factors that play in. I was just reading a report from Stanford Business School that said 1 in 7, this is from Ilya, who does a lot of research on the IPO world, where they said 1 of 7 IPOs were pulled in 2022. And by the way, those are ones that were pulled. There were a lot more that went through, even when they might have chosen a different path otherwise.
Yeah, I think from a legal and regulatory perspective, it's exactly what we just heard, that there's a much greater ability to communicate with the market in a SPAC deal. So in an IPO, really, you're making these filings with the SEC, and there's a very limited ability to go directly to the public, to investors, to get them excited about it. Everything is very strictly prescribed. Whereas in a SPAC process, you can communicate with the market much more freely. You can actually use social media, which a lot of people do. You can put out press releases, tell people about different things. All of this is after you've announced your deal and before you close. So you're drumming up excitement. You're able to pivot. You're able to get a sense of the market, if there's an issue, you can make changes. So there's a lot of different things. The other thing I'll also point out from a company perspective is that if there's a valuation gap, so in other words, you think your company is worth this and the market is saying right now they'll give you that, you can build in an earnout. So what that allows you to do is to say, okay, we'll go out with it being here, but if the stock performs in the future, then you can actually, basically get more shares. And that's a nice way that you can sort of make back that valuation. In an IPO, once you set your valuation and you go public, that's that. You can't take that back again. So that's another important distinction.
Yeah, Mariam, I also want to add that, at some level, no one will remember whether a company went public via an IPO or a SPAC, except for a few set of people who are involved in the transaction. So, and I also want to acknowledge that there is sometimes also the emotion between going the IPO route versus the SPAC route. But if you set all of that aside, we've spoken about some of the specific considerations like speed, ability to share more, and the predictability of pricing.
Thank you. And I would add that going I'm public with SPAC also gives an ability to partner with extremely experienced and talented group of sponsors, such as Athena, for example. So that is, and that is always in instances where people who are involved in the SPAC sponsors stay on the board of the SPAC. So I would say that that is definitely something that I would call out from my side. But going back to the Joel's and Isabel's points, there is no secret that there are like a lot of SPACs outstanding, and founders end up talking to a couple of them at the same time. So what advice do you give to founders? What are the key things they should be focused on when meeting with SPAC sponsors? What they like because that can be overwhelming and confusing at the same time. So what do you tell audience? Like, you have the company, what you should be looking for in the SPAC sponsor? And I would invite everyone to comment on this topic because it's such an important topic.
Yeah, choosing the right SPAC is important. You want to make sure that it has the right investors in the IPO and the right set of relationships. So you want a SPAC that has long-only type of investors that have the capacity to invest in pipes, one that is actively engaged with the investor community to think creatively through various financing options. So for example, some financing solutions, in addition to pipes, are backstops, debt financing for the right candidates, strategics, pipe derivatives, forward purchase agreements. We don't like those so much because they're typically subject to the investor's investment committee approval, so they're not really worth anything. They were more popular a few months ago, but we've turned them down. But you want quality. You want, as Miriam pointed out, a team that can understand what it is that you do and advise you. And if you are able to sell your story and believe in it, then you're good. But we at Athena, for example, have been selective about partnering with the right company and the right candidates to vet and diligence, to line up all the elements required for success.
Yeah, from my perspective, I would echo a lot of that. I think really the team is extremely important. People who, as a company, just do what they call a SPAC off, where they line up 10 SPACs and say, which one's giving me the best economics, I think are missing the point here. This is a very personal transaction. When you have a strong team that knows what they're doing and has the right people surrounding them, they really can make all the difference between a successful deal and a deal that is painful and faces a lot of roadblocks going through it. So, and that's not only during the SPAC process. You also obviously want a team that's going to help you as a company and open doors for you and provide strategic advice. So even though there are hundreds of SPACs out there, I would argue that for any given company, there probably are only a handful that really would fit the bill for that particular company. And so I think it is really important to be discerning when as a company you're going out to the SPAC market.
Yeah. Miriam, from having been on the other side and been on board where we've had to approve venture capital term sheet versus going public via IPO/SPAC, certainly the three attributes that I'd call out, and not surprisingly, they're all there in spades in the Athena platform, because that's what I saw from the other side. One is the focus of investor and operating expertise. This is a long game, so you want to make sure you have the right expertise across the table. To execution capabilities, and have they done it before? Do they have the right mix of expertise in the team? And three, a focus on long-term value creation. Someone asked the question on the Q&A about the legal landscape and the number of lawsuits. And so, it's super important that you pick a SPAC partner who knows how to do it and operates without cutting any corners. If I look at the team that we have put together in Athena, Isabel had an SEC regulator on the first SPAC, and same thing with Athena Technology too. We have a regulator. We have Sharon Brown-Ruska, who was the chief economist, U.S. Department of State, brings extensive expertise. Especially being an all-woman SPAC, our bar is even higher to make sure we are beyond reproach in terms of everything that we do. So just looking for that execution superpower, that long-term value creation focus, and the right team in your SPAC sponsor is super important.
Thank you. And Isabel answered most big part of my next question. So I would go back to you, Kirtiga, and looking from the other side, right? Where you have extensive experience in investing in private companies, and now you're a CEO of the SPAC who is looking for a target to take the target public. So when you're looking at the target, when you're looking for SPAC, or when you were looking for example, when you were at SoftBank, what are the differences and how different is the lens you're looking at the companies from two perspectives?
Sure. I'll actually start with what is the same in both processes. And remember, SoftBank Vision Fund is a late stage investor. So again, there is commonality in terms of the approach. So one, a big, bold vision in a space with a large TAM, to the use of next-gen technologies in providing differentiated solutions to the market. 3, a very strong management team, a founder and entrepreneur with a bold vision and deep insight about the consumer and the industry. Those are all aspects that are common in both. In terms of the differences when it comes to SoftBank Vision Fund investments, they're many times earlier in their growth stage than the kind of companies that we are looking at for the SPAC, where for the SPAC, we really are looking for that predictability of revenue, where that might not be the case in a private investment. Is the team ready for operating at a public market standard? Might not be the case when you're doing a SoftBank Vision Fund investment. And do we see the path of the team getting ready to support that processes? So those are some of the differences in what we look at. And I'll end again on a commonality. In both cases, we're looking at how is it that the team can help amplify the ambition. The mantra of SoftBank Vision Fund that I deeply think about is shared vision, amplified ambition. So whether it was my Vision Fund investments or with Athena Technology too, thinking about, do we have a shared vision? And given the strength of the team, can we help amplify their ambition in access to public equity capital markets?
Thank you. And now I'm both Isabel and Kirtiga. I mean, it is kind of obvious that you have Athena Tech 1 and Athena Tech 2. So definitely tech sector is hot among SPACs, and there is so many verticals inside tech. But what are particular sectors and industries that have been most attractive for SPACs, and what make them attractive? What are the characteristics?
Yeah, initially the most attractive industries were all those that supported the fourth industrial revolution, Web 3.0, in part because there was a universe of equity growth investors that haven't had the exposure, as we talked about earlier, and who were very aggressive about supporting those companies because they wanted that exposure. Today, the market sentiment pendulum has swung more closely to the traditional definition of a company that meets the standards of effecting an IPO, which means more economic visibility to ratify the viability of the company, its strategies, and its growth prospects.
Yeah, just to chime in there, I think, going back in time, it was very difficult initially for many, many years to do a SPAC for do a SPAC deal for an early stage company, and you really needed to demonstrate that there was at least revenue, preferably positive EBITDA, things like that. And then really the pendulum swung to what we saw in 2020 and 2021, where you had a lot of much earlier stage companies going public through SPACs, revenue not required, a lot of times with potentially very exciting technology or products, but still at a very early stage. And unfortunately, as things happen with those types of very early stage companies, some of them are going to be successful. Some of them are going to be a little overly ambitious in terms of how quickly they're going to develop what they're planning to develop. And the public markets are not that tolerant of delay and things like that. So I think you're seeing right now a pullback to a large degree in that particular area. And so I think there's a lot more focus on making sure that the company either, if it hasn't been generating positive EBITDA, or it doesn't have a lot of revenue, really drilling down on its ability to get there in the shorter term.
Mariam, if I could jump in with some of the questions that are coming in on the Q&A.
Yeah, Mariam, there are a lot of questions. One
yep,
is
we can open to questions. Yep, definitely.
Yeah, so it says it says, I'm new to SPACs, so great information, thank you. Some say the SPACs have limitations. What do you say to those that say potential for capital shortfall when more public shareholders redeem shares than expected? Sponsors may be forced to turn to debt markets or raise more pipe financing. Compression timeline, burden on target company's management team as they prepare required financials and filings and establish public company functions while hitting key growth targets.
Let me talk to the redemptions. There are many ways to mitigate redemptions, by the way. The best way to mitigate redemptions is to pick a good company with great long-term shareholder value prospects and add to the valuation that you agree upon. So, but the key is to come to an agreement with the sponsor as it relates to minimum cash to close. So that can be done through very non-redemption agreements, for example, or by attracting pipe investors. But to be clear, if a combination has been announced and the stock is trading in advance of the closing at $9.99, then the investors should redeem because they get $10 on the redemption. They can go back in the market and buy the same stock at $9.99. So the important thing for companies is to make sure that they are partnering with a sponsor that has real capabilities to do that and that is ready, willing, and able to engage on their behalf to help the company. And also that they have investor relationships that they can bring to the benefit of the company. So for example, we have a sponsor that has been with us throughout all three SPACs that has done about 50 SPAC deals with a team of 30 people dedicated to maintaining relationships with investors. And that's very valuable. But as a company, clearly you don't announce an agreement unless you have the minimum cash that you think is needed to go public, and until you know that it has been committed. So, and if that's the company's goal, because there are companies who don't care as much about getting the cash and prefer not to spend the time on that, and some just want to go public and have a very long-term view. But another reason why it's important to choose the right SPAC partners.
Okay,
So,
I see another question. It says, would you project that more and more companies will go after SPACs rather than IPOs? And could that in any ways disrupt the market in terms of some of the risks that could be associated with SPACs versus IPOs?
AGK, just on the former question, I just wanted to underscore 2 points. As Isabel mentioned, I think the key thing for the entrepreneur is to have a very strong sense of what the minimum cash to close is and what is it that is needed to have the company track on the growth paths needed and agree on that with a sponsor. And with quality sponsors, they have a variety of different ways to make sure that that minimum cash threshold is met. One, of course, the right company with the right valuation, and two, things like redemption partners who help with redemption and the like. So certainly ways to address that. In terms of the compressed timeline, AJK, which was the other part of the question, honestly, it is actually a lower burden than the traditional IPO process, because a SPAC sponsor takes care of all of the process part of going public, and I think in the case of the last of Heliogen, the business combination was announced in March, and the company went public in December, right? So you're talking about that kind of time frame. Of course, every situation differs, but that's directionally the range in terms of the timeline. And then AJK, to your question, do you project that more and more companies will go after SPACs rather than IPOs? Could that in any ways disrupt the market in terms of some of the risks that could be associated with SPACs versus IPOs? Isabel, Joel, do you want to take the first part at that one?
I mean, from my perspective, I think we've really reached a point where, at least through 2021, we pretty much saw that a lot of companies shifted toward the SPAC rather than traditional IPO. So I think we've already seen that. I'm not sure it's going to increase necessarily. I think there'll always be companies who decide the traditional IPO market is better for them. I think it's really a question more sort of, will there be a pullback? Will people now shift themselves more over to IPOs? I think in the end of the day, what's important to note is that with all the volatility that there has been in the SPAC market, there's been similar volatility in the IPO market, where the returns on high growth companies, earlier stage companies that went public in 2020, 2021 have also pulled back a lot. So I think there'll be a continued place for SPACs, maybe not at the frothy levels that they were at in 2021, but will always occupy a very substantial piece of the market. And just from a risk perspective, I actually don't think there are specifically really any more risks in SPACs. I think that the disclosure regime is virtually the same. You get the same SEC review that you have in a regular IPO. Not everyone understands that. And I think even a lot of reporters who report on SPACs don't always get that right. It's the same SEC review. So I think that if investors read the documents and understand what they're getting into, I think that the risk profile should be really about the same.
Thank you, Joel. There is one quick question about can SPACs do cross-border acquisitions? From regulations-wise, yes. It depends on the SPAC sponsor or their strategies, but I would defer to Isabel Kirthika if you're looking at companies not in US.
Yeah, it does depend on the sponsor strategy. There's also some legal complications and tax considerations. But it is a little bit more lengthy to take a company public that is based abroad, that wants to go public in the US, listed on the New York Stock Exchange or NASDAQ. But I think I will pass it on to Joel to discuss the legal implications also on that depend on where the SPAC is incorporated.
Yeah, I think you hit the nail on the head. I mean, tax is definitely a much more complex thing. And it's really because most of the time when you have a non-US company, you have non-US shareholders. And so you have to go through a lengthy assessment of the tax consequence. Obviously, in most of these deals, the owners of the company do not want to have a tax event when they do this deal, right? They want it just to be going public, but not that they get a big tax bill. So that takes longer. There are other structural issues that you deal with, but we've seen lots and lots of non-US companies choosing this route. It's just like any IPO. You have to decide that the US capital markets are the place that you really want to list and that makes sense for you to list. But again, there have been a number of deals that have been non-US, and I'm actually seeing that increase more and more recently, but definitely a little more complexity in doing that.
Yeah, definitely. From banking side as well, like I've seen, like as I said, I've worked on a lot of SPACs, and I've seen multiple non-US targets going public in US. Like, so it is definitely a possibility. So
yeah,
Mariam, there's another question that's related to the team that was both in the chat and in the question and answers, right? What kind of operations team that one should have how well-rounded the management team is going to be. So specific to SPAC, what should the entrepreneurs or the target company should worry about in terms of rounding up their team or crew?
Well, we look for companies that are ready to go. So we look for a management team that we can back, who's doing a good job, and where we feel comfortable standing behind. Now, maybe Karthika can add more color on that, on the transition from a private company to a public company.
Yeah, so I have seen everything from a company that did not have a CFO at the time that they engaged on the SPAC process and pulled off a very, very successful SPAC, to companies that we are talking to, where certainly we are looking to help with the operator plus investor expertise that Athena Tech 2 brings to support the team in hiring their next independent board director and or filling in key gaps in the management team. So I would say it's actually no different in a SPAC versus an IPO listing. And you really want to have the right team in place who can help propel the company to the next wave of growth. AJK, I also want to take another question.
Yeah. Please take that question that had the 600 SPAC question. Yeah, please go ahead. And can you read out the question and answer, please?
Yeah. So this has come up in both the Q&A as well as the chat, which, and Mariam, you referred to it as well, with over 600 SPACs looking for targets and not that many private unicorns left in the private market. Like, how do we think about that dynamic? And what's interesting, and Mariam, Isabel, and I looked at this extensively as we were putting Athena Technology 2 together. If you look at the number of unicorns in the market, and this was closer to the end of the year, it was about over 900. And the number of unicorns were only growing. And the difference between the number of VC-backed IPOs and that delta between number of unicorns and VC-backed IPOs was also growing. So while there's a lot of conversation about so many SPACs and are there enough targets, honestly, what we have seen with Athena Technology 1 and with Athena Technology 2 is the reverse question, which is a number of high quality targets and where is it that we have the best mutual match in terms of optimizing that short-term and long-term value. Even more so as you look at the spaces that Athena Technology 2 focuses on, which is fintech, enterprise, health tech, deep tech. Again, SPACs in the space are outpacing in terms of returns the overall SPAC market. So we are very excited actually about the kind of targets that are out there for which SPAC is the right vehicle.
And in terms of predicting what's going to happen to the 600 SPACs that are looking for combinations now, there are a lot of SPACs out there where the sponsors have no experience in bringing companies to the public equity markets, and they have little in the way of resources to contribute to a combination partner. So for companies today, the bar has risen, and therefore there are many of those SPACs that will expire not having executed a combination. So I think what we can expect is that there will be a shakeout among SPAC sponsors, and those that have created the very best platforms like Athena will thrive, and as will their combination partners. I think we'll also see more companies that have a proven track record and a very clear path to growth and profitability. However, all of the benefits of a SPAC versus a traditional way IPO remain, and the very best sponsors will leverage their capital markets and industry experience and their network like we have to drive further value and be attractive partners for many of the unicorns that you're talking about, and that will be leading companies of tomorrow that want to access the public equity markets. So I think in that you'll see as more innovation in and around the SPAC product, and in a way probably more than in any other product on Wall Street. It will be interesting.
I think this
I think what people
question,
forget, just one point on that, I think what people forget is that heading into this, the number of public companies that exist in the United States had gone down very significantly from what we saw, 10 or 15 years ago. So there was really a pent-up demand. You sort of had this phenomenon where people were just staying private longer and longer. And there were reasons for that, but people say, what do I need to be public for? There's so much cash in the private markets. Why don't I just stay private? But in the end of the day, there are also a lot of advantages of being public, and those started to become more and more apparent. You have liquid currency, you can make acquisitions with your stock, you can compensate your workforce with options, RSUs, things like that. There's so many great things you can do as a public company. And I think the pendulum started to swing again. So it's actually historically, should be able to be accommodating to that number of new public companies and more, just to get back to historical norms.
yeah, thank you, Joel. So there's another question. I think this is directed, I'm assuming, to Radhika, to Kritika. It says, from running PE to a SPAC, how has the public company demands, including reporting requirements, changed? Both your lives, macro outlook affecting the markets, and 3, institutional investor demands.
Yeah, actually, I think Isabel, I think you're perfectly suited.
I'd like to pass it to Joel.
So sorry, I apologize. Could you just repeat that last part of it?
No, so should I read it again?
Yeah, education.
Yeah, if you don't mind, thank you.
Yeah, it says, like, from running PE to a SPAC, how has the public company demands, including reporting requirements, changed? Both
And
your
Maria
lives,
might have a
macro outlook affecting the markets, and institutional investor demands.
Yeah, I mean, if you're asking the difference between the reporting requirements as a public company, certainly there's a lot more demands. And I think one of the questions earlier was talking about your team, right? And the important, what do you need to really have? I always tell people the most important focus is on the financial side of it, being able to close your books on time, get into the cadence of the public reporting. And when you're a PE-backed company, you don't necessarily have that same level of reporting, certainly not to audited financial statements in the same time frame, or even your quarterlies in the same time frame. So there's definitely a lot of demands. And when we work with companies that are going public through a SPAC, we bring in kind of almost, some companies are very well built out, but a lot of them are not. And so we have almost a SWAT team that comes in and helps basically get them public by making sure that they understand everything that needs to be done. And we develop a calendar for them and all things like that. And they get the same type of thing from the auditors, giving them the same thing. So there's definitely a big difference between the way it is when you're a private company and a public company.
Okay. The other question is, can a sponsor be subject to stagger their compensation over a finite period of time, or have lockups so as to not swing the SPAC pricing during its infancy?
Yes, that is something that is done. We have had, for example, staged lockup release up to a certain period of time where the sponsor is compensated along with the stock price increase, where a certain percentage of it will be released when the stock price hits certain targets. So 12.5, 15, 17 is typical, but that is very much done.
Thank you. The other question is, as a private investor, how does one get in the deal flow of upcoming SPACs so you can pick and choose what you want to invest in?
SPACs are traded regular way on the stock exchanges. The different SPACs choose to be listed on different exchanges. So it's the same way you access any other with any other name on the stock exchange, you can access any SPAC. And the same way you do diligence on any stock you want to buy as a retail investor, you can do the diligence on the SPAC as well.
Well, if you're talking about investing in the sponsor, in the risk capital of the SPAC sponsor, it can be a little tricky because you have to know sponsors who are in the process of forming a SPAC. So, and those opportunities, it's a very small pool of capital. So those opportunities can be a little tricky to access.
Right, but just getting to, if you are talking about going into the public shares, I think that's actually one of the great democratizing aspects of the SPAC. In IPOs, it's very hard for individual retail investors to get into an IPO. And by the time the IPO is out, let's say, you have the IPO pop, as they say, the stock may already have run up by 20, 30%. You don't have the ability to do that. Most SPACs, there was a period of time where they just went up even after the IPO, but most SPACs, when they do their IPOs, tend to trade around the $10, maybe a little higher than that, until they announce a deal. So really, if you like the team, if you like the Athena team, if you like another team, you can go into the market and buy the units or the shares when they separate at around $10 a share, or rather a unit, just the same way that the institutions did and the people who were in the IPO. And then you're sort of sitting there, and then when they announce a deal, you have the ability to look at that and say, I like this company, I don't like this company. And you could either choose to stay in or not. But that's actually one of the big differences, that there is extreme openness to retail investors.
And this other question, it says, is a score, SCOR, still being used, or has SPAC replaced it? Is there a thing called SCOR score or something, Joel, or?
It's not ringing a bell. So I apologize.
Okay.
I'm not sure
All right.
what that's referring to.
I don't know I don't know either. So there's another question related to EBITDA. What is a typical time for a company that has got reasonable EBITDA to pursue a SPAC?
Miriam?
Yeah, so sure. So depends on where the company stands. I've seen like a lot of companies without an EBITDA going public via SPACs. That's the beauty of the SPAC, obviously. Then you can market your projections and take company public based on the projections versus existing EBITDA. The readiness for going public via SPAC is purely depends on how ready the company is to, when you say that I'm gonna have like 40 million EBITDA in next quarter, to meet that, to make sure that you hit the targets and to make sure you're ready to be public. You have to be a certain size in terms of the valuation as a company to go public via SPAC. I would say billion mark is minimum sweet spot to consider going public via SPAC. But in terms of the EBITDA, I've seen a lot of EBITDA negative companies going public.
Yeah, I mean, the key is that the investors want there to be liquidity in the stock. And when it's too small, the valuation overall is just too small, it's difficult for them to take a position. These funds that invest today are so large that in order for something to really move the needle for them, they have to be able to put a decent amount of capital to work. And so if the company is too small, then they can't really get good positions and liquidate their stock in an orderly fashion. So that's what we're basically seeing. Now, there have been over the last couple of years some success stories where you've had companies that are less than that, let's say 500 million or around that. But those are proving to be more of the exception than the rule. We're generally seeing around $1 billion, right, being the kind of entryway.
Joel, can you speak to smaller SPACs that are now somewhat limited in their ability to go public at the New York Stock Exchange?
Yeah, I mean, look, smaller SPACs are, SPACs, as I said, originally were $50 million vehicles. Then they just got bigger and bigger to the point where you had, we did one last year that was $1.7 billion, right? That's a lot of capital to deploy, and you've got to do a very, very large deal. And you saw, for example, like the most famous being Bill Ackman's SPAC, which raised a huge amount of money. And really, there are limited targets to find when you raise such a huge amount of money. So I think that you definitely want to have SPAC that has, let's say, a few $100 million to it, because you have a lot of flexibility. You can always raise additional capital. But yeah, it's the exchanges have different minimums in terms of what you need to have to be on it. I think NASDAQ is actually the most forgiving. I think you can go even at $50 million. But you, again, the same point being that when you have too small of a SPAC, you're typically looking at a target range, which is small, and then that's become more and more challenging. The place where you see smaller deals done is biotech, because those companies tend to just have much lower valuations, and you see smaller SPACs being raised to focus on that area. Biotech, of course, unfortunately being an area in 2021, which was just decimated effectively by the public market. So right now we're not really seeing too much new issuance in that sector until we see that market start to turn around.
I think we are getting to our end of our session. Kritika and Mariam, and I know we have a few more questions, but I really don't know how much time you all have. But we also don't want to lose the audiences of the time. So perhaps some closing remarks, and if somebody can answer a couple of quick questions, and then we can end it. So
Sure.
Kritika, you want to there?
Yeah, there's a question that Kumar asked, which says SPACs can hide companies' liabilities and business weaknesses that the market would want to know about versus IPO. Is this acceptable? And I think this goes back to what Joel was talking about, is just around disclosures and SEC guidelines. And from an Athena perspective, certainly we are very supportive of disclosures and making sure that we are presenting the most in-depth picture of the company that allows the market to value it appropriately, and making sure that we are operating beyond reproach. I'd say for all of the entrepreneurs who are in the audience, it is just tremendous to reflect on the amount of change that is happening in the market and how disruptive technologies, AI, IoT, data, automation is changing every industry as we know it. Could not be more excited to get to learn about your vision and your plans for the future, and feel free to reach out to any one of us. Think what is the right thing for long-term value creation, and whatever that is, private, public, IPO, SPAC, certainly wishing the entire audience tons of luck and the transformation that you are driving.
Thank you, Kritika. Thanks. I want to thank all the panelists and everyone who participated in the event. Feel free to reach out if you have any questions, and I'm sure everyone is open to that. And thanks for giving me the opportunity to participate.
I will say that Citi is one of the top underwriters of SPACs, and we are very grateful to have Citi be the sole underwriter for Athena Tech 2. So Mariam, thank you.
So are we. Thank you for being great clients.
So thank you very much on behalf of TiE. I really appreciate the panelists for enlightening us, and it's a continuous journey. SPAC has been around for a long, long time, and I think it'll be there for years to come too. So the more learning that as a community we can get from people like you, I think maybe there are more targets and more SPACs to come. Thank you very much.
AGK, thank you. Thanks to TiE